Hello everyone, welcome to the Bowtie Breakdown. I'm Garry Morin The BowTieGuy. Today I am at Sierra Pacific Mortgage in North Providence with my friend Peter Nastasi.
Morning, Garry.
Good morning, Pete. Thanks for letting us stop by. Today Peter's going to talk to us about the importance of credit scores and how your FICO scores are derived. So Pete, can you kind of fill us in? What is a FICO score?
Sure. So there's many different models out there, right? So in the mortgage industry, we rely what's called on a FICO score. And that's basically the algorithm that's used for qualifying for a mortgage.
Okay.
So there are variables depending on program, right? So with conventional, you're really going to need like a 620 score. FHA will let you go, much lower. You can be into the fives.
FICO score is also basically your credit score.
Yes, essentially.
Okay.
So there's different ones. So a lot of people they'll have access to, some of these online credit companies, right? That you can get your score every month. People say, oh, my score went up. I think I have a 740. And then we'll sit down with a client, we'll pull their credit, and their FICO score is actually a little lower.
Yep.
So what's used on those sites are a little different algorithms, right? There's different types of scoring models.
Okay.
What we use in our industry is the FICO model.
Okay.
So the FICO model is how that algorithm works is it takes into somebody's credit as a whole. So meaning, is their credit broad? What I mean by that is, do they have car loans? Do they have credit?
Space, a lot of credit.
Yeah, they have a lot of credit. It shows how they manage it, right? So they got a car, they've had a mortgage, they've had maybe student loans, they got store cards, they got credit cards.
Different types of credit.
That's part of the model.
Okay.
Also part of the model is how you utilize your credit. Have you been making your payments timely over time?
So these are two important pieces, it sounds like.
Yeah, and it's even a little bit more. So you also take into account where, let's say somebody has a limit on their card of $1,000. If they owe $999, that's going to bring their score down. So you want to stay at, say, 30% or less in that revolving. So if you've got a $1,000 limit, you want to be around 300.
Because that's your credit utilization, right?
Yes. If you're maxing out your cards, it shows that you're not really managing your credit as well as they'd like to see it. So if those utilizations are high, your score will be a little bit lower.
And you said the ideal utilization is around 30%?
It's around 30%,
okay.
yeah.
Good to know.
And the other misconception people have is they let's say they have a card and they pay it off. And they're very excited.
I've got to pay off my credit.
I got to pay off my card, and then they call and they cancel the card. That's the worst thing that somebody can do, because the length of credit, a length of time you've had a credit card or some type of installment, that weighs into the scoring. And it's a big percentage. I want to say it might be 30 or 35% of how that score is modeled. So if you've had a card for 10, 15 years, and you all of a sudden shut that down, now you're getting rid of all of that good history that you had. Yep. So you want to pay that card off, that's fine, and just leave it be.
So the same thing would apply, like if you pay off your card and then like the credit card company shuts you off?
Most credit card companies will leave that card open if you have paid it off in good standing, meaning you weren't forced to pay it off, you weren't late, you weren't behind on payments. If you are using that card and making payments on time and you pay it off, most of the time a credit card company will not shut you off unless it's been years that you've actually utilized that card.
If it's like 3 years you didn't use the card.
Yeah, they may shut it off.
That's kind of the question I was getting.
Yeah, they maybe not know why. Could you be deceased? Anything could happen, right? So they may shut that card off.
Yep.
But if you have the card and you don't call to cancel it, most of the time that card will remain active for quite a while.
And it's important not to cancel it.
Correct.
Is what you're telling us.
It's so critical. I've seen clients that we've sat down with over the years, and we will help them maybe to get their score up a little bit so they can qualify. So we'll give them some, just some tips, right? Because we're not a credit scoring agency, but we'll give them some tips to get their score up. And what they do is they sometimes don't listen. They pay it off and then they close it, and then their score drops. And they're like, what happened?
So it literally can drop.
It can literally drop,
because like you said, you're shortening that length of credit time.
Correct, because now that card's closed, so it kind of is falling off, and now you've got just what you have left, and that might be recent cards that you've opened where there's not a depth of history. If somebody's well established, they're a little older, they've had mortgages, cars, and stuff like that, it's not as big of an impact. But if somebody's young and they haven't had vast credit in the past, they haven't owned a car, they haven't owned a home,
they could be hurting
and they're just living on, they've had credit cards, young people for instance, and they stop closing cards that maybe have been open 5, 6, 7 years, it can really affect their score in a negative way.
Wow, I don't think a lot of people realize that. So FICO score, is that one score? Is it 3 scores?
No,
can you kind of tell us what's the difference between the 3 scores, the 1 score?
So basically you have 3 bureaus, right? We have TransUnion, we have Equifax, and Experian.
Yep.
Those are the three major bureaus in the country. And again, so the FICO model, they all can utilize the FICO model. And that's a credit report that mortgage lending will rely on.
Yep.
Unfortunately, right? We don't use, there's been talk over time that maybe we'll adopt a different model, but until the agencies do that, it would have to be across the board. It would have to be across the board because everything is based on the FICO score on that model. So each bureau will have the algorithm for a FICO score, and then we just merge those three together.
So it's not like an average of the three. It's a totally different thing than an average.
Correct. We will use the mid score.
Okay.
So now there actually is talk about averaging some scores.
Okay.
But it's going to be a little difficult to implement because ultimately, at the end of the day, everything is based on the mid score. So the mid score, what I mean by that is, your TransUnion could be a 700, your Experian could be a 720, and your Equifax could be a 740. We're gonna take the mid score, which would be your 720.
Gotcha.
So we're not gonna take the high, we're not gonna take the low.
Right in the middle.
We're gonna take the middle, and that holds true if you have multiple borrowers. So you could have two borrowers on an application. One borrower has that 720 score. The other borrower's mid score might be a 620. Well, we're gonna use the lower of the two. We can't use the higher as much as we'd like to because we want to give the borrower the best options, but unfortunately we have to take the lower
end of it.
Yes.
Okay, that makes sense because we want to make sure that the client and customer can afford the mortgage ultimately.
Correct. Yeah, and then that person who's on the loan with them is equally responsible for those payments. So if somebody has a lower score, that's going to weigh in on the likelihood of those payments being timely.
Especially if that's the primary person making the payments.
Correct.
Right?
So that's
the person with the higher score could be responsible.
Yes. So that's why lenders will take the lower of the two borrowers.
So that was Peter Nastasi talking about credit scores, FICO scores, and how they are derived and how they are important for the borrowers. That was another Bowtie Breakdown. I'm Garry Morin. Thanks for watching. We'll see you next time.